Hello, Jim here. Today I want to share with you one of the greatest ways to make passive income, and that's selling options. I'm actually going to change my focus a bit today. In the past, I've typically looked at what I call value companies, companies that pay really good dividends and grow their dividends. Today I'm going to primarily look at growth companies. I'm going to share with you a few that I'm investing in currently, and I'm going to share kind of a unique strategy that I've just recently started doing, and it's called the poor man's covered call. So I'm going to share with you the basics of that strategy and the trades I've made related to that strategy. So stay tuned. I think you're really going to enjoy what I have for you. Let's go ahead and jump right in. I typically like to start my videos talking about what's happening in the economy. I don't have much to share from last week. I do believe that consumers are doing a lot better. Actually, some numbers have come out showing consumers are doing fairly well. And also, inflation is still a bit higher than what the Fed likes. So because of that, my guess is this higher for longer is going to continue. I was thinking maybe that they would do a cut in March, but I'm thinking that's probably off the table. We're probably looking more at April, May, or June for the first cut. And because of that, I think the market's going to still stay pretty volatile until we get those cuts. So I think the next couple of months may be like what it's been this week. You know, one day up, another day down, and then maybe the third day is kind of sideways, a little bit of a mixed market. So again, that's my 2 cents, and it's probably only worth 2 cents, but I typically do like to share that. So I typically invest in what I call value companies, and I've been investing in value companies going back probably 40 years, since the 80s. On occasion, I've invested in some growth companies, but overall, I've missed the opportunity of some really good growth companies. I vividly remember Apple. I had an opportunity to invest in Apple around the time that Microsoft kind of saved Apple. They gave Apple a couple $100 million, I believe, just enough to kind of keep them going. And over the next couple of years, Steve Jobs came back and Apple just shot through the roof. And I think back to that day where I really thought about buying Apple, and I should have done it. So going forward, I'm trying to identify any growth companies that may have that kind of trajectory or could grow that quickly. So that's one thing that I'm looking at. And there's a couple of companies, especially with the AI stuff, that I do think will have an impact, especially companies that can adopt AI. I personally use AI and find it very helpful. I find that I don't have to do Google searches as much, especially for my programming stuff. Whenever I have a bug, I can go straight to ChatGPT and it'll help me find the bug versus having to, search probably for hours through Google is what I used to do. So I want to find some growth companies that relate to, having that potential takeoff growth, a company that may grow 20, 30%. I define a growth company as a company that's growing 20% a year and then is very profitable. I don't typically invest in companies that don't make money. So maybe they potentially will make money in the future, but I don't start investing in them until they are profitable. And most growth companies don't pay dividends. So, that's one aspect I don't like, the fact that I'm not getting the dividends. But in some ways, if a company doubles or triples, over the next 3 or 4 years, whereas a value company may only go up slightly or, 10 or 20% over 5 years, missing out on the dividends may not be that big a deal because, the growth company would be worth so much more that you could potentially, if you needed some cash, you could trim your holding, which I suggest you do that from time to time. If you do have like NVIDIA or a company that's shot through the roof, I do own some NVIDIA, and I've trimmed some of it because it's just gotten so expensive. I figured at some point it's going to come down to earth. So for long term, not having the dividends, the fact that the stock rose so much can outweigh, having the dividends, even though I still like dividends. I've also found, and most of you probably know this too, that just by the nature of companies being growth companies or growing very quickly, that they also have a lot more option volume and premium, and in a lot of cases have more expirations and opportunities to sell options, both as put options and call options. And that can be a big difference. Sometimes value companies don't have as many expirations and typically don't have as much volume. So that's something that can have a big impact. If you're an option trader like I am, I can potentially make a lot more money. And I'm going to talk about that at the end of the video when I share with you the candidates that I'm using for the new strategy that I want to talk about in this video, which is the poor man's covered call, or the PMCC. I looked at two growth companies and I kind of compared them and contrasted them. One thing that's really interesting about the two companies I did pick is the fact that neither one of them have debt. And they're both growing at a pretty big clip. One is significantly smaller than the other one. But at the end of the video, I'll talk more about that and go into a little bit more detail and share with you the trade that I actually did. So what is the poor man's covered call? It's the ability to set up a type of trade where you can do covered calls. So instead of actually buying the stock, you pick a future, and I picked over a year. I actually picked a leap for purchasing the call contract. So instead of owning the stock, you buy a call contract deep in the money. Typically, it's like an 80, 90 delta. So, and the deeper it's in the money, the more it moves with the price of the stock. So if it's an 80 delta, then it's typically moving like 80%. If the stock goes up by $1, it'll go up by 80 cents, or goes down by $1, it'll go down by 80 cents. Or 90, if it's a 90 delta, it would move up by 90% and down by 90%. So you get the basic gist of it. And what it allows you to do is not to use so much money. So if you were looking at a $50 stock and you wanted to maybe have right covered calls on it, you needed 100 shares, that would be 5,000. So by buying a call that's deep in the money, it may only cost you 20, 30%. So you don't need to use as much capital. So if you have a smaller account, it potentially can work out really well for you. Plus, if it's a growth company, it can really work out well, because the whole idea behind the growth company is if it's growing its profits 20% a year, then by the end of the year, the earnings should be a lot higher. Plus, their future projections, what they're projecting they're going to earn the next year, should also be a lot higher. So again, how you structure that trade is you buy farther out leap, like an 80 delta. For my trade that I'm going to share at the end of the video, I went out a year. Now, once you have that in place, then you can sell covered calls. I'm looking at doing it on a monthly. So the third Friday of every month, I'll sell a covered call using those expirations. So I'll do the next day the market's up, I'll sell a covered call, and then I'll gain that revenue each month. And then after a year, hopefully I've been fairly profitable, with the premium coming in from the covered calls, as well as the value of the stock. If the stock has gone up, 30, 40%, then the value of that covered call, or not covered call, the purchase call will be a lot more, and I could sell it for a lot more, or I could let the shares be assigned to me, and they would automatically be assigned to me at a much lower price than what they currently are at that time. So that's the main way it works. And the big benefit is you don't need to use as much capital. I'm going to, again, talk about a lot more of this in the end of this video, when I compare and contrast two of the stocks that I decided to look at for doing this. So, and I also, before I jump into that, I do want to mention, please subscribe, hit that like button. If you're interested in learning more about my memberships, details will be below. I have 2 levels. I have what I call the Investors Club. You get access to my trades, you get access to my spreadsheets. I also have a bunch of collections where it's almost like one of the collections, so it's almost like a class. It has 6 lessons. I share how I got started and how I've kind of progressed over the last couple of years of trading options. Then there's other collections related to some stuff that my son and I are doing, as well as some basic questions or unique questions that members have asked that I've set up a collection for that. So take a look. The higher membership is what I call the traders membership or active traders membership. And it includes coaching. I provide coaching on a weekly basis, typically between 15 and 30 minutes. For new members, it's usually closer to 30 members, or if you need a lot of hand holding. And then for a lot of the other members, it's like 15 minutes. They typically want to run trades by me. They might ask why I made a trade or have a general question for me or ask me, am I missing something with my trades? So I'll give them advice. And it works out really well. I enjoy talking with those guys. Plus, I do have a monthly group meeting that we're meeting at 8 p.m. on Sundays, and it's open to my traders club. And we usually have anywhere from 6 to 8 people that join, and we share strategies. We talk about tools that we can use. So if you're interested, take a look. I do have 1 week free if you want to try it to get a feel for it. So that being said, let's jump into the next part of the video. I've opened up another new spreadsheet. This is what I'm using to compare two different growth companies and doing the poor man's covered call. So the first one is Palantir. It's a very good company. It's got good growth potential, has no debt. Looks like it does grow anywhere from 20 or 30% on a yearly basis. It's profitable. So it's not that expensive. Currently it's around, I believe, $16. So the current price when I set up this spreadsheet yesterday was $16.21 for their stock. So here you can see I purchased stock at 80 Delta, which was a $12 strike. And then, so here's the first one is the purchase of the call for January 2025. And it was literally exactly a year later. I believe it's January 17th, 2025. I bought 4 contracts. And primarily why I chose 4 contracts is I also looked at, and I'll share it below, Zoom. Zoom is another company I like. I've been selling cash secured puts on them for years and have done quite well with it. So I wanted to buy, one that was similar in value. So 400 or 4 contracts is pretty close to the price of Zoom. 16 times 4 is fairly close. It's, I think, within $1 or $2. So that's why I chose 4 contracts. I chose a $12 strike because, again, I believe it was like 82, 83 Delta. So again, it'll move a lot with the stock. And plus I like 12. It seems to be a good price. I would really be surprised if somehow Palantir ends up below 12. And then I ended up having to pay $6.23 for each contract. And then of course when you multiply that by 4 and then 100, the price that I paid was $24.94, which was about half of, probably more than half the amount of what I would have needed if I had bought the shares. If I had bought the shares, I would have needed 16, so what, about 6,400, I guess. So it's more than half. It's like 40%. And then each of these, this is really rudimentary, but it was based on the actual delta and details from the option chain. So I was just looking at a month out and just assuming I could get $45 per contract for each month at a $19 strike. And that was literally looking 30 days out. That's what I noticed I could get. Now, Palantir was down yesterday, so potentially this could be a lot higher. So these numbers, like the 180 repetitively through the year, would not be the case. It would probably be like 170, 200, 160, 215. It'll be a little bit all over the place. But just for an example of where I would stand by the end of the year, so I would end up earning about 180 on a monthly basis. And at the end, all these added together minus the $24.94, I would end up having a loss of $514. But at that time, I would also, still have this Palantir 4 contracts that I could then sell, and then the current price that I came up with looking at the option chain was $4.55, which would bring in about 18.20. So the net result of selling the contracts at that time. Now, I probably would not sell them if Palantir happens to be pretty close to that 19 or even higher, 21, 22. I may very well take the 400 shares because, again, I really want to own it. I don't want to be one of these situations where I've had a good trade, but I don't actually own the shares because, again, it may be 400 shares, but if they double like a lot of the growth companies do, they may do stock splits. They may do a 2-for-1 stock split, and suddenly it's 800 shares, not 400 shares. And that relates to almost like a 52% return using real basic calculations. I think I could potentially do a lot better than the $45 on a monthly basis. And, plus these 19s, they wouldn't all be 19. Some would be probably 18, 19, 20. And I'm using kind of a mid-level 25 delta for each one of these. So if, say, in July, the Palantir's 25 delta for calls is 18, well, I would use 18. Or if it's 20, I would use 20, with the main emphasis of, still having it quite a bit above what I paid for originally. So that the higher the stock price goes, the better it would be for me, and the more I'd make a higher return, or end up keeping a stock that I paid, only $12 for, that, would be very profitable in the future. Now, I also looked at Zoom. I also like Zoom. Zoom has no debt. Again, I looked at a 20 or an 80 delta. And then for the monthly expirations, just like I said before, 20 some odd delta, like a mid 20 delta. And for them, it was a similar situation. I was looking at buying the 50 a year out. So the strike of a 50, and it's currently at $69. This was yesterday. I think it dropped to 67 today. So I did the same calculations. I also looked at the, what the mid 20 delta, which ended up in $75 looking at yesterday's chain. And again, I just used the same numbers, but I could not bring in as much. It was a lot less premium compared to what Palantir had. And again, just like Palantir, yesterday was a down market. So the numbers were probably smaller than what they would typically be. But it gave me kind of a good basis to look at it, how profitable this could really be. So at $88 on a monthly basis, towards the end of the year, I would have spent $14.32, and then would be the loss. So it'd be the $2,400 minus all the $88. But then I would potentially be able to sell the call that I had purchased and pick up another $19, which the end result would be, and this is the 1900 minus 1432, which would give me $468 and about a yearly return of 20%. So again, I don't know how accurate this is. It's very rudimentary, but it gives me a basis, and it helped me decide, well, who do I want to try the poor man's covered call? And it made it an easy choice because it looked like I could do a lot better with Palantir at this time. So that's the route I went. In both of these companies, I've sold vertical put credit spreads and done very well. I currently don't own any Zoom, and I probably have done 70, 80 trades on Zoom. Palantir, I've only done 1 or 2 trades on with using vertical put credit spreads. I may even try an iron condor at one time, depending. That may be a little bit more risky because it could shoot through the roof. So it was a fairly easy decision between the two, but again, I like both companies. They're both good growth companies. I also looked at another company, UiPath, which its ticker symbol is PATH, and I believe it also has no debt. So again, another good opportunity. I didn't get a chance to actually compare it, but if you might want to, if you also want to kind of do this kind of analysis, you could also do a third one with PATH and see if maybe it would potentially be even better. I think it sells at more like $20 a share, and I do think it's not quite as profitable as Palantir. So that's it. That's what I wanted to share. Over time, probably over the coming months, I'll probably share where this stands. Again, if it by some for some reason, if it rockets through the roof and goes up to 22, 23, I might end up having it assigned away from me early through the call, which would make it even more profitable. So like if you look at this May, if it suddenly gets closed because of early assignment, then actually it would be very profitable, even more profitable than this 52%, probably more like 100% or something along those lines. So that's it. Thanks for joining me. If you have any comments or you think I'm a little nuts with this calculation, please share it. Please add a comment. And again, thanks for joining me.